Welcome everyone that's joining. We're just waiting a couple of minutes as the conference is just open for the day to allow people to assemble, and we'll get started. Okay, I think we can get started. Hello, everyone. My name is Cheryl Hicks, and I'm a senior advisor to the United Nations Global Compact CEO Water Mandate, which is focused on business actions for climate and water. And I'm chair of the board at ACE Infra Partners, investing in sanitation economy infrastructure. And I'm really pleased to be your MC for today's panels. Today's theme of the conference is mitigation. And the COP26 summit, which is coming up in November in Glasgow, will bring the parties together to accelerate action towards the goals of the Paris Agreement and the UN Framework Convention on Climate Change. Developed nations have promised to raise 100 billion a year US dollars to support climate change adaptation and mitigation in vulnerable countries. So our question today is, what is the role of business and what are the opportunities for commercial investors? Business can bring solutions, expertise, innovation, technology, and new business models. Financial and market innovations also play major roles in driving the transition to a low carbon economy. Today's session will focus on these financial innovations that are already driving the transition as our first panel, and the energy transition, sustainability advancements in transportation in particular as our second panel. We'll also have a networking session at the end of the two panels at 12:45 Eastern time, and you'll get some instructions on how to participate in that at that time. But don't wait for questions and chat and commentary. Please use both the Q&A function of the Zoom platform as well as the chat function to ask questions and leave comments live, and we'll try and navigate those with the speakers and experts who are online. So that is our day today. We're so happy to have you with us for this day of the conference. And without further ado, I'm going to get us started. Really pleased to have kicking off for us today as our keynote speaker, Paul Goyden, Managing Director and Senior Partner at BCG, and he is leading the North American energy practice. Thank you, Paul. Over to you. We look forward to your remarks.
Yeah, thank you, Cheryl. And it's a pleasure to speak with you today and to kick off this very important session that we're having here on climate and sustainability. I wanted to share some thoughts from BCG from our work across sectors and across continents on what CEOs and corporations can do to tackle climate change. It's a broad topic, but as we're learning every day, not just in the COP26 run-up and discussions, but with clients and investors around the world, it's going to take an ecosystem and it's going to take the entire planet, including corporations, to tackle climate change. And there's a very, very important role that we can play here in the private sector. The first thing that I always point out is we are far from perfect. Even with our COVID-19 dip in carbon and greenhouse gas emissions, current announcements are incredibly far from a 2.0 or even a 1.5 degree path. And if anything, if the world is going to tackle climate change, we're going to have to accelerate the rate of change. We're going to have to accelerate the rate of commitment. And every year we delay this conversation means that the slope and the pace of change only accelerates to get where we want to be by 2050. And so when we talk to CEOs and boards around the world, we can assure them that what's happening today is only going to get faster and faster if we're going to reach our climate ambitions. We're facing in climate and sustainability a global generational challenge that is going to pose threats to existing sectors and industries, assets and infrastructure, and business models around the world. And when we talk about this with clients, we see there's four interrelated challenges that we need to tackle as an economy and as a society to get the world where we want to be in 2050 and 2100. First and foremost, we absolutely have to transition to a net zero economy and reduce the greenhouse gas intensity of economic growth and what we produce for the world's citizens. Part of this is also creating a more circular economy. And as the population continues to grow, reducing the impact we have on the planet in a way that still satisfies consumer demand. We know that the path to net zero won't necessarily be linear, and that we're going to have to transform our land, food, and water systems to feed the world of the future. And finally, corporations and governments are both going to have to embrace adaptation and resilience. As Cheryl said in her opening, it's one of the themes today, that we're going to have to protect critical infrastructure as climate is already changing in ways that we haven't predicted. So these factors are impacting businesses around the world. The fundamental economics of groundbreaking technologies from wind and solar to energy storage are changing at an accelerating pace. Public sentiment and regulation are changing the corporate landscape. 40% of the world's population already lives in a country with some form of carbon pricing either in force or soon to be in force. And finally, financial flows are moving to more sustainable and lower greenhouse gas products, and investor sentiment is one of the forces of change that businesses and CEOs are dealing with every single day. These factors mean that the CEOs face a more uncertain world, and businesses will have to rise to the challenge. So when we walk in and we talk to a new client in any sector, any part of the economy globally, there's three things that we like to talk about that focus the conversation on climate and sustainability. First of all, what parts of your business are going to be impacted under what scenarios? What are the threats that are created that we need to understand and mitigate and adapt to? Second, what are the opportunities that are being created? Where can we play in sustainable and low carbon products and offers? Where do we have opportunities to create new businesses or new sectors of the economy, such as carbon capture or carbon storage? And finally, how do we as a company not just have a positive impact on the world, but how do we win? How do we set up our shareholders, our employees, and our stakeholders for a successful future given so much uncertainty? We've laid out a six-step process to take business leaders through creating value while tackling climate and sustainability. First of all, we have to recognize that everything is accelerating. Every year we delay reaching a 1.5 or 2 degree pathway only means that the future rate of change will need to increase to save the planet. Change is happening in exponential ways in segments and sectors that we can't and haven't predicted. We know that the pathway will not behave in the way a report lays out in a very linear, orderly function. There's too much uncertainty, too much fundamental change in technology. As proven time and time again in BCG research, early movers are going to have an advantage in prime assets, understanding consumer sentiment, and getting access to scarce resources. Climate will be no different. Businesses and CEOs that lean in will have access to first mover advantage. Climate is changing the game, and we need to understand and follow that and be in front of it. I'll talk a little bit later about the building blocks of a net zero transformation. And finally, anything we talk about today in terms of ambition and action is likely through the lens of history to be viewed as conservative and insufficient given the magnitude of the change and our current pace and trajectory. As I said, we believe early movers will have an advantage. The advantage will start from an employee value proposition. Our research shows that over 90% of many talent pools globally want to work for a company that's leaning in on climate and sustainability topics. We see potential new products and revenue upside, operational savings from having more efficient, lower energy supply chains, all the way through preferred access to financing by being a leader in addressing climate and sustainability. CEOs and boards that have made climate commitments and have started to carry through on them, many have seen their cost of capital decrease because they're seen as a lower risk investment. We also talk about how we can change the context, how we can not just play the game, but shape the game. We believe that we need to actively engage with regulators, policymakers, business partners, and supply chain partners to actively shape how we're addressing climate challenges, and that companies can be a force for good in moving forward the conversation. Those 4 generational challenges that we laid out at the beginning cannot and will not be solved by any individual party or even individual sector of the economy alone. They're going to take ecosystems to come together to collaborate across and through supply chains, from raw materials through end consumer demand, to actually drive what's necessary to decrease the greenhouse gas intensity. Companies are going to have to absolutely disrupt their business model. As we've seen in every transition that major industries in the world has gone through, sectors flourish and new sectors come up and are created. There will be green disruptors and green unicorns. There'll be new business models that are created. And the companies that disrupt and think about those will have an advantage in long-term sustainability. We fully believe, and we've seen with our clients who are ahead in this journey, that climate and sustainability action, net zero commitments, also can drive cash to the bottom line in the short term. A supply chain that is greenhouse gas efficient is often also lower cost, shorter transportation, faster reaction to consumer sentiment and demand, production closer to consumption. And there's many core operational topics that drive the bottom line that also lower your carbon intensity. And we challenge all of our clients in any industry to lean in and pioneer a net zero low carbon product, begin engaging consumers, whether it's B2B or B2C, on what it means to have sustainable low carbon offers in your portfolio. Certainly not all the early offers will be blockbuster offers, but they are going to help you and your companies learn. And again, we believe the early movers will have a long-term advantage in understanding consumer sentiment and market evolution in low carbon products. So as I said earlier, we believe there's multiple building blocks for a corporation to start a net zero transformation and to start the net zero journey. This all starts with business leaders today need to understand their carbon footprint. Making a commitment to move forward on climate begins with understanding your own supply chain, your own scope 1, 2, and 3 emissions, their sources, their variability, and having that baseline. It also means that we have to understand the full end-to-end risk of climate exposure that we have in our portfolio, from our physical assets and our plants and our supply chain, all the way through financing and marketing and customer demand. We need to define our new business model, including new net zero businesses. Where are value pools going to be created? Where is margin going to be created? And how can we play in those markets? We also recognize that all greenhouse gas emissions likely cannot, with today's technology, be abated. And we're also going to have a corporate position on assets and how we start to offset as we create a pathway and interim targets to net zero. And we always encourage our clients, as I showed you on the very first slide, we are not on a net zero trajectory for 1.5 or 2 degrees. So each of us in our personal lives and as business leaders need to set ambitious targets that, if achieved, will take us where the world needs to go by 2050. That means that we have to lean in on economics and technology and be realistic about where we're going in the short term so that we can deliver, but also recognize ambitiously where we need to go in the long term as a society and as business leaders. We then take that strategy and we break it into 2 parts. We have to focus on net zero operations. In the short term, net zero operations and efficient lean operations are going to be very highly correlated. We can decarbonize our core manufacturing footprint. We can fully understand and get into our supply chain and where the carbon is in our supply chain and where our scope 2 and 3 emissions are that we can optimize and reduce. As we think about our capital budgets, planning infrastructure, plant construction, et cetera, we have to build physical resilience to our climate risk in everything we do in our supply chain and our footprint and our manufacturing base. And then, as I said, we're going to create opportunities in new businesses. So we have to also look at our net zero business portfolio. What's downstream of us where we can invest and partner, and also where we can build businesses that unlock green growth. We've already seen any number of businesses and startups focused on new technology and new business models. And finally, our organizations are likely going to have to adapt. We find that leaders in climate and sustainability that are moving on their net zero ambitions are radically transparent with information and emissions so that employees can understand not just the financial impact of their actions, but also the greenhouse gas impact of their actions and decisions. And the organization has to be mobilized. This is a critical part of our employee value proposition as business leaders, and we have to mobilize our full organization. It's not going to be simply 1 or 2 departments in corporate that lead the charge on a net zero company. We're going to have to access new talent pools and capabilities. We're going to have to help the world develop the skill sets to manage greenhouse gas intensity, manage lean and efficient supply chains. We're going to have to bring those talent pools into the companies, and we're going to have to partner with universities to create more talent to meet our green ambitions. Finance flows, as I've said, are already changing and investing in lower carbon businesses, and we see more and more investors wanting to invest in companies, funds, or vehicles that have a net zero commitment. And we're going to have to engage with NGOs and policymakers and shape the landscape so that we can have a clear, consistent, and logical regulatory framework. All of these things together are going to help us set up businesses for a resilient future and a pathway to net zero while being profitable and sustainable for the long run. And with that, I'll hand it back to you, and maybe there's a few questions from the audience that we can take before we go to the next segment.
Indeed. Thank you so much, Paul. Wow, that was full of great advice. The roadmap for business leaders on how to win and creating value while addressing key risks on their net zero journey. Just a couple of key points that I took away. First mover advantage is key. As climate changes the game, not just to play the game, but the opportunity to shape the game, and the need to be thinking about disrupting business models to create value in the future context, and finally to build in resilience to everything that businesses do, and so much more. And there are a couple of questions in the Q&A. Perhaps I can just read out a couple of them, Paul, and you can take a quick response, and then we'll move on to the next panel. So the first question is about any specific companies or sectors that you can point to that are the best so far at achieving net zero GHG emissions. Tough question. That's question one. And question two is just about leadership and CEOs that are really taking this roadmap to its fullest optimization.
Yeah, I think your first question is challenging in that companies, society today is far from net zero, but there's really great examples of companies in a range of industries that are well on the pathway and creating value for shareholders while doing it. There's an industrial company that has created a whole series of consumer products based off of recycled materials, and they are actually a carbon negative company because by recycling these materials rather than the original end use in landfills and their manufacturing process, they've actually net taken carbon out and put it into these recycled products. There's several energy companies that we work with that have done fantastic work actually leaning in and putting substantial capital into carbon capture, building hydrogen businesses, and building sustainable aviation fuel businesses. There's consumer companies that have started to create low carbon supply chains and start to market low carbon companies. So I think what we're seeing innovators lean in, from startups trying to create carbon negative products all the way through some of the largest companies in the world, redirecting 10 to 15% of their capital into new low carbon products. But we're still very far from any single company or sector being close to net zero. But I think there are examples of people well on the way while making money for their shareholders on the journey. What was your second
Paul.
question,
Very encouraging examples.
Yeah.
The second question was around leadership. That what you've outlined as a roadmap for CEOs. Are CEOs really taking up? There's a sense that that CEOs are not doing enough.
Yeah, that's a great question. We do CEO learning sessions at BCG all the time in small groups. And we're absolutely seeing that CEOs today are expected to be visible leaders of their company and in the communities they operate. And that employee engagement is highly, highly correlated with CEOs that are leading from the front and visible on these important topics. And then employee engagement is highly correlated with successful companies that deliver long-term shareholder value. It's absolutely imperative that leaders today embrace the climate conversation, understand how their companies can make a difference, and then engage with their employees and stakeholders on their path and the challenges and the opportunities presented by it. Absolutely critical to be having that conversation at every level.
Thank you, Paul. That's all that we have time for just now in the live Q&A, but there are other questions popping up, and I know you're going to be with us for a few more minutes, so would love for you to lean in and provide some more insights. Also check out the chat, and for everyone that's just joining, we just had Paul Goyden, our keynote speaker, with a fantastic roadmap for CEOs on their transition to net zero, and now we're going to move to our first panel, and today is the mitigation day, and so we're going to be focusing on both finance and innovation. So our first panel is about finance, and to introduce our first panel on the topic of financial innovations to drive the transition, I'll hand over to the moderator of the session, Sid, who is the Finance and Business Operations Associate at Form Energy. Over to you, Sid.
Thank you so much. Really excited, everyone, to moderate this session, and thank you, Paul, for providing some keynote thoughts to frame this conversation. Yeah, it's incredibly exciting to have this conversation hosted within the Wharton community. I think it's something I started to learn a lot about, the sort of intersection of business and climate change while I was a student at Wharton, and my classroom experience helped me break into this space. So it's exciting to be here today. So our panel is called Financial Innovation to Drive the Transition. So this energy and climate transition that we're embarking upon, it's a multi-trillion-dollar challenge that's ahead of us this decade and over the coming years. And so it'll require financial innovations as much as it will technology and policy innovations. And I'm excited to introduce my panelists. You know, all Wharton alums, which is very exciting and really flexes the strength of our network across industries. Before I introduce my panelists, I just want to share a little bit about the Wharton Energy Network, which I'm the president of, one of the other alumni associations of the Wharton School. So the Wharton Energy Network is the alumni association for energy professionals at Wharton and Penn. We have over 4,500 members, and our mission is to support the alumni community and Penn and Wharton broader efforts overall in leading the energy transformation by providing a forum to support connections and lifelong learning about the business future of energy and climate. So you can check us out at whartonenergy.com. That out of the way, I'll introduce the panelists. First, Dawn Powell. Dawn is Vice President of Stepstone Group, where she focuses on responsible investment, which encompasses ESG integration and impact investing across private markets, asset classes, and investment strategies. She's also a member of the private equity team, focusing on venture capital and growth equity and diverse managers. Before that, Dawn was Investor Relations Officer and member of the ESG team at Capital Group, an investment management firm with over $2 trillion of assets under management. Joining Dawn is Camillo Patrignani. Hope I got that close. He's an Executive Vice President of Energy at the Libra Group, a diversified holding company active in 35 countries across a number of industries and asset classes. Camillo has over 20 years of experience in the finance industry with a particular focus on clean tech. At the Libra Group, he has strategic oversight over global clean tech and renewable energy operations in the US, Europe, and Latin America. And finally, we have Tim Short, Managing Director within KKR's infrastructure investment team, focused on energy transition, renewables, storage, and related energy infrastructure. Tim has over 18 years of energy, power, and renewables related experience, including solar voltaic engineering, power and infrastructure investment banking, and also was a climate change advisor to the Australian government. To date, Tim has been involved in over $14 billion of invested capital in clean energy assets. So please join me in welcoming our esteemed panelists, and we can kick off the discussion. Format-wise, we'll go with 1 to 2 rounds of focused questions for each panelist, and then depending on how we're doing with time, we can have more general questions for the panelists, and then we'll carve out the last couple minutes for Q&A and wrap up at 12 Eastern. All right, so Dawn, would like to go to you first. There's a lot of institutional capital coming into the climate space. There's the Climate 100 and task force for climate-related financial disclosures to support standard setting. How are institutional investors keeping companies accountable, and how do you differentiate between the GPs that are doing the real work from those who might not be walking the talk?
Thanks, Sid. So institutional investors really are addressing climate change in their portfolios by, number one, investing in climate solutions, actively deploying into opportunities in the energy transition, for example, but then also, of course, mitigating climate risk across their entire portfolios. This often includes engagement with existing investees. So generally, this is happening right now through collective action with groups such as those you mentioned, like Climate Action 100+, the IIGCC, and in alignment with recommendations of the Net Zero Asset Owners Alliance, TCFD, ICI, UNPRI, Science-Based Targets. I could go on and on. There are a number of initiatives out there. Thankfully, they're all talking to each other. And if that just sounded like complete alphabet soup, maybe I'll double click on one of those. So the Net Zero Asset Owners Alliance has over 50 institutions that have signed on, committing to transition their portfolios to net zero by 2050, consistent with the 1.5 degree scenario, reporting regularly on progress and establishing intermediate targets every 5 years. So these commitments, we just heard in the previous panel or the previous keynote on setting net zero targets at the company level, this is happening at the investor level as well. And then the engagement has to flow down to the fund managers and the companies. So in private markets, which is where we operate within Stepstone, often this engagement is happening by first holding the fund managers accountable through extensive due diligence and annual monitoring questionnaires, really to ensure they are engaging with their portfolio companies, raising climate as an issue at the board level and reporting on progress. Now, this is important to institutional investors. I don't want to harp too much on this because I think this audience is pretty bought in to why we need to address climate change, but just very quickly, there's mispricing out there right now. So the degree to which climate change is included in asset prices and risk premia really varies. And I think there's a clear opportunity to enhance risk-adjusted returns by appropriately considering climate risks and opportunities. And then second, this resonates with the stakeholders of the pension funds and all of these asset owners who are signing on. Wildfires, hurricanes, floods, I could go on and on, but the physical risk of climate change can no longer be ignored. And pensioners are really calling for their boards to set their portfolios to align with the world they want their grandchildren to live in. And then the second part of that question is, while that all sounds really nice, how do we make sure that the GPs or the fund managers who these institutional investors are allocating capital to are really contributing to solutions and mitigating climate risk in an authentic way and not just greenwashing. There's a lot of regulation that's being developed at the moment, specifically the Sustainable Finance Disclosure Regulation out of the EU is seeking to regulate greenwashing very closely. So for funds that are labeled as sustainable or impact, there are rigorous disclosure requirements. It's pretty complex to prove alignment with the European taxonomy. So fund managers really need to be sure of this classification before painting, words like sustainable and impact all over their marketing materials. In the US, we are a little bit behind, but SEC did issue its first greenwashing risk alert a few months ago. And we do believe at Stepstone that other national and regional taxonomies will emerge following in the EU's footsteps. So while regulation's still being shaped, the onus is on us to weed out the greenwashers. We do this in a number of ways that I'm happy to elaborate on perhaps as we continue in this discussion. I'll just really briefly mention, a solid ESG foundation. So we look for managers that are building impact and climate change programs on a strong and solid ESG foundation. And we also have really live discussions with these managers to suss out the authenticity of their approach. We do reference checks to see, our portfolio company CEOs saying, yes, the GP was helpful and raised these, issues during diligence, and our incentives aligned. So our specific impact or ESG targets kind of tied to portfolio company management bonuses, and maybe even at the fund manager level, some managers are putting a portion of carry at risk and tying that to specific impact or climate targets. Even that can be greenwashed. So we need to ensure those targets are appropriately ambitious and validated by a third party, et cetera. And then finally, on the measurement front, we want to see alignment with recognized standards versus, proprietary kind of clever metrics and really transparent reporting on those. So an example of what we've seen as best practice, a recent investment we saw, this manager was performing fiscal risk assessments using third-party data sets, aligning the financial upside, downside, base cases with specific Paris pathways, setting science-based targets with short and long-term emissions reduction goals, tracking progress against those through annual reporting to LPs, and more broadly, just identifying ESG risks and opportunities and targeted impact outcomes, value creation plans to address those throughout the holding period, and then following that up with clear measurement and reporting. So obviously very passionate about this topic, could go on and on, but I'll pass it back to you, Sid.
Yes, it's definitely clear that transparency and kind of increasing the linkage with financial performance will be really critical. And I just want to take the opportunity to highlight a class both Don and I took with Professor Veet Henish. He teaches a class called Corporate Diplomacy, where he talks a lot about stakeholder engagement, and he's done some research on ESG and analytics with Engine Number One, which has been making headlines for their sort of activist approach towards kind of sustainable value creation. So great. Camilo, we'll go to you. So obviously climate is a global challenge, and I think in the US at least, sometimes we tend to have a myopic, developed worldview of what the energy transition looks like. Given that you've had extensive experience across Latin America and Europe, could you just speak to what lessons you've learned as you've worked across those markets?
Sure. Hi, Sid. First of all, thank you for having me. And sorry for the lighting, but I'm in a hotel room with which is very, very dark lit. So let me start with the growth. Actually, when you look at Europe, the US, and Latin America, you see in Europe basically a territory where renewables, starting with wind and solar, started maybe a decade before the US. And so what we've been seeing in Europe is sustained growth, but they still have about twice the installed capacity in solar, for instance, than the US has. And you look at the US and it's been catching up over the last few years. So for instance, last year, the US installed about 19 gigawatts of solar, while Europe installed about 15. Now, this widening gap of seeing more growth in the US is not necessarily going to continue. I mean, if you see at the power prices in Europe last week. I think in Spain, they were at around 300 euros per megawatt hour. And it's really an energy crisis that's going on. So that's going to be a continued driver for renewables. Now, just to map it out, in Europe, you have basically Germany leading the charge. And then there are another 4 countries that have above 10 gigawatts of installed solar. So the numbers aren't huge. You know, it's Italy, Spain, the UK, France, and the Netherlands. When you look at Latin America, just jumping to this other territory for a second, it really had underperformed. You know, I found an interesting Wood Mackenzie report issued on 2017 that was projecting Latin America to have about 40 gigawatts of installed solar by this year. And we are at barely, not even 10 gigawatts today. And some of the reasons, and perhaps I'll focus on this, which, you know, are some of the lessons we learned in staying in Latin America. You know, in Europe, it's a more mature, more stable market. There haven't been a lot of lessons learned per se, as it's been over the course of 20 years. It's just been an evolving market. But in Latin America, we really learned lessons, you know, and it's interesting when you look at the power prices, you know, compared in Latin America compared to the US, we're pretty much on par. They're very similar. And so when you're trying to bring in renewables, you don't have the benefit of an investment tax credit, production tax credit, or renewable energy credits, or any sort of incentives, just because these nations are more poor, you know. I think an interesting aspect that's been at the forefront, at least for the last, well, I say since COVID started, is that the credit rating agencies have been very active, not in a good way in Latin America. They downgraded 4 countries. In fact, they downgraded Peru. In all last year, they have downgraded Peru twice this morning. Panama, Colombia, El Salvador. And if you really look at the credit profile of Latin America, there are only 5 investment grade countries, and out of 34 countries and territories. And then out of these 5, you have Panama and Uruguay that are really tiny countries. And then you have Chile, Mexico, and Peru. All 3 have political problems of some nature. So anyway, dealing with these downgrades and a negative outlook on the economies, it makes it hard for money to get to Latin America. Another interesting aspect is that 60% of the power matrix is renewable in Latin America. I don't know if many people know that. And it's largely or only due to the amount of hydro they produce. So power prices are low because they're driven by hydro prices that are very plentiful. But over the last 5 to 10 years, the rain patterns have been changing. There's been more droughts, and this power generation technology has become less and less reliable. So I think that's going to be a driver for Latin America to continue to diversify their energy matrix. And just to finish up very quick on cost of capital and availability, you know, Europe has the cheapest cost of capital compared to even the United States. And that has to do, in my view, with structural issues around project finance once you layer up the tax equity in the US. And your debt financing is in the form of back leverage, which is more expensive than regular project finance debt. And then Latin America is even more expensive, I would say, by a much longer stretch. And this has to do with, you know, attracting this capital in Latin America has to do with, you know, things like I mentioned, the country risk, a lot of corruption, even on the permitting process. It's actually, I have a lot of stories to tell if I have the time. And then the one of the main, perhaps, is the currency volatility. Most of the PPAs are signed in local currency. And then you look at global investors, they mostly have funds in euros or US dollars, and the hedging is prohibitively expensive. So anyway, I hope this helps you just map out this territory at a high level. That'll be all from my side, Sid.
Great. Yeah, it requires a lot of specialization and understanding of local markets to be able to deploy capital effectively. So appreciate that perspective. So shifting from a plane of geography towards a plane of I guess technology or subsector, Tim. You know, when people hear the energy transition, quote unquote, renewable energy is what they typically think of. But you know, you've been investing in clean energy infrastructure for a number of years, and you know, I think the audience would love to hear your perspective on what areas are more mature, what's more on the emergent side, and what's just the hype cycle.
Sure, thanks, Sid. Pleasure to be here and talking with you again. Thanks. Happy to take that one. Look, I don't want to downplay the role of renewables in the energy transition. It's by far the biggest single subsector of where most forecasters expect capital to flow between, say, now and 2050 in the 1.5 degree scenario. I think it makes up close to half the capital, but there are a number of other sectors, to your point, that are important and ancillary to that. And they hit on a couple of themes. I think one that I would highlight straight up is electrification generally. And so we're seeing, for instance, a shift from traditional hydrocarbon fuels to use of electricity wherever that makes sense, particularly if it can be greener electricity. It's happening across the board. So oil and gas midstream operators are looking to electrify, and many of them are or have already electrified material portions of their compressor fleets or their prior functions, and you know, doing that with cleaner electricity. You're seeing a lot of national sort of school bus fleets or bus fleets increasingly looking for electrification solutions, and they need capital to do that because the upgrades, the retrofits, the charging stations and so on, that all needs to be paid for. And so you have this electrification taking place, you know, really across the board, including in buildings and so on and so forth, which I'll get to. The challenge, I think, with all of this is that we've just had a really long period of underinvestment in the grid, and the grid was made to run one way, and it's now dynamic. We have, you know, the most simple version being rooftop solar, net metering, and you know, all the way through to sort of virtual power plants, and FERC 2222 is coming, and we're going to see a lot of change. But investing and upgrading the grid is a slow process because it involves FERC, it involves the ISOs, it involves the utilities, and you know, regulatory, the public utility commissions, and so on and so forth. So that's a headwind that we have on this sort of great drive towards electrification, which is going to be underpinned increasingly by renewables. But if you look at the where sort of people predict the capital will be needed outside of renewables, power networks and their management and their smart management, if you like, integrated with the resource and the demand is probably the second largest bucket of capital that needs to be you know, mobilized and invested in. But it will take time. Interestingly, energy storage is a lot smaller. And while we are seeing, you know, a lot of interest in energy storage, I think there are challenges. Even the utilities interconnecting these batteries, and you know, we've done this, don't fully understand how to work with the systems and integrate them. And so it's creating challenges, putting aside the supply chain issues that we have. But storage is certainly, you know, part of the solution to some of the transmission issues and part of the solution to electrification. The other theme, I think, which is worth touching on, is really decarbonization of industrial processes and buildings. And it's a theme that we're seeing emerge across a lot of different sectors, but that's probably the next biggest bucket of investment capital required in order to reach some of our goals under the 1.5 degree scenario. And you know, that sort of opportunity is more difficult to capture. It involves working ideally with large portfolios of property and therefore their owners. So New York Law 97, I think it is putting the onus on those property owners to decarbonize their buildings starting in a couple of years. And with that should come an opportunity for kind of what I'll call ESCO 2.0, which is a better way of saying energy as a service, because I think that's become cliched. But we do need a more advanced version of our energy services companies to provide these solutions to decarbonize sort of industrial processes and properties and buildings and commercial use. On the emergent side is hydrogen, and hydrogen's fascinating. There's a lot of talk, and I think it's going to be a slower process. I don't think you want to be the first to build the mega electrolyzer, and you probably don't want to be the second either. But it's likely to play a pretty important role. Some of the lower hanging fruit around hydrogen, which might come sooner, are things like green ammonia and its use in fertilizer, which improves the carbon footprint of certain agricultural activities, and also blending it in natural gas pipelines. You can't, hydrogen doesn't make sense to run through pipelines with 100% hydrogen content, but most end users, and certainly all the sort of gas combined cycle or aeroderivative units can take at least 20% hydrogen. Even that would be a huge amount of hydrogen. So I think we'll see this come, but it still has some technology risks associated with it. It's still not an incredibly mature industry, but a lot of people are certainly chasing it.
Awesome. Thank you, Tim. We had a few questions actually on hydrogen, so I'm glad you touched on that. So I think what we'll do is cover a few of the audience questions, and then I think to wrap up, we can kind of have a big picture thought from each of you. So I'll go to Camilo. We have a question. What part of international aid helps subsidize the development of renewables in developing countries? So you might be on mute.
Sorry, can you repeat the question, Sid, please?
Sure. What part of international aid helps subsidize the development of renewables in developing countries?
Well, there really aren't any subsidies in Latin America whatsoever. You have some countries that have tax benefits. For instance, they may allow you to do accelerated depreciation. Some countries may have a good net metering regulation. There are some incentives that are unfortunately tailor-made for the main utilities in each country. So, for instance, there's a funny one. You know, Colombia has a program similar to the ITC, the investment tax credit, but is not transferable. So here you can do, you know, for instance, a flip structure where you flip ownership from a company like, you know, Google or JP Morgan that can take all the taxable attributes of the project. But in Colombia, you can only do it if you have the taxable income or the tax appetite. So it's non-transferable. And the main utilities all do have that taxable income and appetite. So you see occasionally a little cheaper debt coming from multilaterals, rarely equity, and they usually ignite. For instance, in Chile, they started the first lenders that financed solar farms in Chile, where groups like IFC, IDB, OPIC, BFC, I believe is at the moment. So, you're really basically competing openly with the market. Not if I addressed the question right there.
Yeah, that's great. Thank you, Camilo. I have a question for Don. Do you see any analysts versus portfolio managers that are seriously competent or focused enough when looking at ESG funds to help drive the solution of the capital markets in combating climate change?
Yes, I would say every large institution is now investing resources and dedicated teams to look at ESG issues in particular. I would say where we have work to do is getting every single analyst completely bought in to the fact that it's important to integrate climate change into your investment decision making. So yes, we have dedicated teams, but I think that where we need to continue to drive change is those organizations need to continue with training and really embed that philosophy into the culture of their organizations and the fundamental belief that climate change and ESG considerations are investment considerations, and you need to incorporate that into your decisions if you want to be a good investor.
Yeah, I would definitely agree with that anecdotally. I mean, even for us at Forum, we recently closed a Series D round, and ESG is a topic that our investors are increasingly asking us about, and we're quite early stage, so this is going to be a big issue. Maybe going to Tim, we got a question about the current energy crisis that's kind of in Europe, but also having some global shockwaves. How do you think about that current energy crisis and how it could affect the proliferation of renewables and efforts towards decarbonization? In addition to any challenges, what opportunities might it create?
Sorry, I'll unmute there. Look, I think the energy crisis, so to speak, is very, very different in different regions. Europe is experiencing something very different to what we're experiencing in the US. The energy markets have a history of righting themselves reasonably quickly, and that's seen, for instance, at the moment in the US that gas is up over $5. The forward curves are telling us that in Q1 it's going to be back down to where it's been for a long time, but that $5 price is having a real impact. I think, I don't like to use this word because I take it out of the, I don't think it fits inflation, but I think it's transitory, the current crisis, and that markets will do what markets do and invest capital in the right places in order to address that. But the real challenge that we're seeing at the moment are supply chains and inflation, and the impact that's having on the ability to meet all of these goals across Europe, US, and everyone else, be they corporates, sovereigns, or states that have set goals that are ever increasing. And we're running into a shortage right now of the supply of enough clean energy to meet those goals. And I think that'll persist for a number of years because of how much COVID and other factors, interconnection queues, things like this have just completely gummed up the system. And that's seen in the volume, massive volume increase in the trading of voluntary carbon units, and the run up in the prices of voluntary RECs. And so I think that's the bigger crisis that we're facing in a world where we're trying to deploy significant amounts of renewable energy. We need the supply chains to be functioning. Renewable energy is inexpensive and therefore can address high energy prices, but unless it can get connected to the grid, unless we can get the equipment at prices that we should be getting at, unless the ships can get to the ports to get it there, then we're going to have some period of time where this is a real challenge for the industry. I think it'll create pockets of opportunity, but at the moment, in the short term, it's a challenge.
Great. All right, to wrap up here, I think, we had some questions around, what is the outlook over the next 10 years? And I think that's good to discuss as a wrap-up question. But I think just given the audience, a lot of us are Wharton alumni, even current students here. We may or may not be working actively on the energy transition in some way. We may be trying to figure out how to break in. So, I would love to hear from each of you. What advice do you have for professionals as they think about the next steps in their career, how they can be part of working on the energy transition professionally? And I'd actually like to start with you, Tim, because this is a topic I know you're passionate about. And in the chat, I'll throw in an alumni spotlight we did of you for the Wharton Energy Network. Tim was gracious enough to share his insights, but if you could give folks a taste of that, that would be great.
Now you're asking me to recall exactly what that advice was. I was going to answer slightly differently, which is I think energy transition probably represents the biggest single overhaul and turnover and capital investment opportunity that we'll see in our lifetimes at the moment. And it's rare that you sit at the early stages of that and it's coming. And so then the question is, okay, how do I tool up to take advantage of that? And I think my answer is actually step back from being hyper-focused on climate and being hyper-focused on the sort of the more touchy-feely side of it. And remember that to make a real difference, you have to have a really deep and fundamental understanding of an incredibly complex market, which is the energy markets. The dynamics of how gas pipelines work all the way through to power markets. Power is the most volatile commodity in the world. It can go from $5 to 5,000 in 5 minutes. And it is different in every state and region and jurisdiction, and market rules differ. But unless you have a thorough understanding of all of those foundations of what make up today's energy economy, then you can't change it tomorrow. So my advice would be have an eye to the fact that will benefit you, but don't shy from learning about fossil fuels and all of the things that make up our current energy economy, because we need to understand them if we're going to change them.
Yeah, that's great. Definitely, there's a lot to learn, but I think understanding, the different sectors and really deep diving is really. Camilla, we'll go to you next, and then Don will give you the last word.
Sure. I mean, Luke said there are a lot of jobs in clean tech today. That'll continue to be the case. I don't think anyone in this network that is interested in finding a job in energy, particularly renewables, is going to have a hard time. I would just recommend they have an eagle eye when it comes to the real sustainability aspect of whatever technology they're working on. Greenwashing is over, and Don was calling it earlier. And a lot of people, for instance, today are talking about blue hydrogen. Well, if you investigate it, turns out that it's worse than black hydrogen produced with coal because of the methane leaks. So get to the bottom of it. Whatever is greenwashing, whitewashing, or whatever is washing anything, just get out of it, because there is no more room for that. So I'll really recommend to keep an eye on that aspect.
Over to you, Don. Thanks, Camilla.
Perfect. Well, I would just say my advice is to start with where you are. So whatever organization you're in, get involved in whatever climate or ESG initiatives are existing, or if they don't exist, be part of the group of folks that starts one. No asset manager, no company is exempt from engagement on climate. Every company needs a climate plan. So I think the way to get your foot in the door is to start with where you are. Companies like Form, we've discussed Sid. Yes, they're adding renewable energy capacity and storage, and it's totally amazing implicit, contributions to the energy transition. And there are other work streams that need to be added, managing, other measuring ESG issues such as diversity, occupational health and safety, et cetera. So even early stage startups, there are opportunities for you to get involved and really start adding value and elevating these issues.
Well said.
And I've said it any better myself. I just want to say thank you to our panelists, Don, Tim, and Camilo. This has been an incredible discussion, and thank you so much for sharing your wisdom and insights. I saw a few more questions come in, but I know we're at time, so I'll hand it off to Cheryl.
Thank you,
Great. Well, thank you. Thank you as well, Sid, and the panelists for this comprehensive and global review of the current state of financial innovations and mechanisms supporting the transition. A lot of great stuff in there, and really encourage you to continue to be with us and address some of those additional questions that are both in the Q&A function of the Zoom platform as well as the chat. Thank you so much.
Thank you.
So we'll now move on to panel number 2 for our day on mitigation. And if we could have the panelists and moderator make themselves visible. Wonderful. So to introduce the second panel, it's the topic of energy and transportation sustainability advancements to watch. This is the innovation panel today. And I'd like to hand over now to our moderator of the session, Arthur von Bentham, who's an associate professor at the Wharton School. Over to you, Arthur.
Thank you very much, Cheryl. Welcome, everyone. So I'm excited to be here with you talking about sustainability advancements to watch in energy and transportation. I think the background of this panel is that we've seen renewable energy grow really fast due to dramatic cost reductions. But then there's always discussion, right, about the fact that renewables are intermittent resources. They can't always provide reliable power 24 hours in the day. So there might be a need for storage solutions and responsive customer loads. And then to add to the challenges of a greener grid, there's also now this new major driver, which is electric mobility. So taken together, we need a variety of options to help address the reliability change of moving to a decarbonized energy environment. And that's what we're going to discuss in our panel today. We have 3 experts who will discuss the challenges and the transitions to a high renewables power grid with rapidly growing electric vehicles. And the way we'll do this is we'll have 3 6-minute mini presentations, followed by some brief moderated discussion, and then I'll hand it over to the audience for Q&A. So I thought, let me introduce the first speaker, and then we'll go to the first short presentation, and then I'll go to the speakers, the next speakers afterwards. So let's start with Joe Oliver. Joe, thank you for being with us. Joe is the managing director at Deloitte Risk and Financial Advisory. As a leader of Deloitte's advisory energy sector practice for government and public services clients, Joe leads engagements focused on energy security and resilience, sustainability, energy diplomacy, utility governance, project finance, so lots of issues relevant to today's discussions. And importantly, he received his MBA from the Wharton School. So Joe, I'm going to hand it over to you for our first presentation.
Sure. And Arthur, just in terms of logistics, am I sharing the slides or is somebody doing that?
If you could share the slides, that would be great.
All right, let's see if we can make that work. The slides are not critical, but let me go ahead and get a couple of things set up here. While we're starting, I am going to focus on renewable energy. The Biden administration, as I think everybody probably knows, announced a very aggressive goal to migrate the US power system towards 100% renewables by 2035. I'd like to talk about the business challenges specifically of doing that. And you notice I did not mention policy incentives, but there are 4 key business challenges that I'd like to draw attention to. Cost, renewable energy integration, which you just mentioned, supply chain constraints, and the scale of the demand requirements in order to get anywhere close to 100% renewables. Make no mistake, and we've already heard about this morning, US power markets have already begun and are continuing the transformation towards renewable power. There is no going back, regardless of which party is in power or who's in the White House, for a variety of reasons. But as the speed and the scale of that transformation, where government incentives are going to be important and where we're going to have to see how fast we move. First, let's talk about cost. In terms of renewable energy cost, solar and wind power have already become the cheapest source of new power generation and levelized cost of energy in most of the US and globally. Hard stop, the cheapest source of new power and ongoing power, really dropping, as we all know, 90% plus over the past 15 years. Even without tax incentives, onshore wind is our cheapest source of power in the US, with solar right behind. Adding storage provides a lot of benefits to solar, but even at current costs, solar plus storage is competitive with gas and more than competitive against coal-fired power. I don't see underlying cost of energy as being a deterrent. More, the underlying cost of renewables is probably the biggest or one of the biggest incentives to continuing with this shift as we go forward. Integrating renewables into the grid does have its challenges and requires work, but many US markets have come a long way in the past 10 years towards already doing this. And the US market as a whole is already at 11% variable renewable energy, 18% renewable resources. And we've got states like Iowa and Nebraska, hardly bastions of liberal hippie environmentalism, that are getting a plurality or a majority of their power from variable renewable sources right now. Those are both very big wind power markets, and we're only going to see that continue. Worldwide.
Joe, can I briefly interrupt you? I don't think your slides are advancing. We're still seeing the first slide with the cost of solar and wind.
I don't know if I can help. Let's see.
I can share your slides if you prefer.
You want to do that? Why don't I stop and you can share the ones I sent you? Yep.
Okay.
All right, so while you're pulling that up, just the point that I want to make is a number of countries around the world, Denmark already at 60%, thank you, 60% renewable power, number of European countries well over 30%. Burlington, Vermont, where Bernie Sanders used to be mayor, 100% renewable energy production, and all those markets doing it reasonably cost effectively. We have a lot of room to come up in markets like Florida, the Southeast, Virginia, that are still predominantly gas or hydrocarbon-based power systems that can migrate more towards renewables if the utilities and the regulators who regulate them choose to do so. Distributed power, storage, and especially dispatchable power is going to be a real key part of moving these numbers up in the next 15 years. The whole concept of distributed power, whether it's as simple as a rooftop solar system or an electric vehicle or a more complex distributed energy system, should be a big part of the solution going forward. Arthur, if you could move to the next slide. I think in the next few years, supply chain constraints are going to be a concern that could slow this migration. As the chart on the upper left shows, many of the key components in battery production are produced outside of the US. China in particular, and we don't know where trade relations will go with China in the future, but also many of the critical minerals and the rare earths that go into battery production mined or developed outside of the US. The good news is many governments as well as private companies are taking steps to boost production, identify new sources of key elements or minerals like lithium, and are rapidly innovating so that fewer elements are needed or elements can be stretched in the supply chain. I really expect that innovation around battery technologies and around reusage and some very simple concepts like increasing how we recycle battery components here in the US will have a big part of addressing this concern going forward. The US really does not domestically recycle components right now that go into batteries. I think that'll change rapidly, and there's already private companies moving aggressively in that direction. If you could move, Arthur. The last point I want to make, and I think this is also a challenge, the scale that's needed to get anywhere close to 100% renewable energy in terms of new power generation is massive. We need to add, based on which of the sources you look at, well in excess of 2,500 gigawatts of new power over the next 15 to 30 years. Just for perspective, the US added 35 gigawatts of renewable power in 2020, most ever, and is going to require 70 to 100 gigawatts of new renewable capacity annually at a capital investment of $1.5 trillion to $2 trillion. So really big scale and big thinking to make that happen. And as many of us know, power projects take a long time to build, to get financed. And we've got pretty large sunk investment costs in our hydrocarbon-based power system. So determining who's going to pay for that transition and whether we're going to force that faster than the depreciable life of hydrocarbon plants is really where policy comes in. But distributed resources, as I mentioned, concept of virtual power plants and really decentralizing renewable energy production is going to go a long way towards doing that. So just to conclude quickly, I know I'm about at time. Renewable energy technologies are the lowest cost provider. They can scale rapidly. System planning, integration, supply chain availability. These are not particularly exciting topics, but they're really critical as we move forward with this transformation. And achieving the 2035 targets is going to require a massive scale up. We're not going to get there without policy requirements or policy levers, which we'll probably talk about in the question session. But I'm really optimistic about how innovation and the technology advancements around batteries and other technologies is going to play a big role in this transformation.
Joe, thank you very much for this introduction. So let's turn to our second panelist. So I would like to introduce Erica Gupta. She is the technology manager for the Buildings Technologies Office in the Office of Energy Efficiency and Renewable Energy. She's also the technology manager for the Sensors and Controls subprogram. Her work focuses on building energy management controls and projects supporting controls for a grid integrated efficient buildings. Erica attained her bachelor's degree in mechanical engineering at BU and then a master's degree in mechanical engineering at the Worcester Polytechnic Institute. And we're looking forward, Erica, to hearing about buildings from you.
Thank you. I apologize. I'm not a Wharton alum like everybody else here, so forgive me, but hopefully I can provide some interesting information for your discussion today. Let me go ahead and share my screen. I will do my best to keep this right to 6 minutes. Full screen. All right. So first, I just want to start by reminding all of us the size of the building sector in the US. It is an enormous portion of the energy use in the US economy, and it's 75%, 3/4 of the electricity that we produce in the US is used in buildings, by buildings today. And if we think about where vehicles charge, as we move to electric vehicles, a lot of them will also be charging behind the meter of a building, right? So that's increasing our electricity use in buildings as well as we think about the future scenarios. We're wasting an enormous amount of this energy today. So we need better insulation, better efficiency. Yes, of course. We also need to think about if we really want to fully decarbonize the building sector, moving to electrification and really increasing the penetration of heat pump and heat pump technologies across the US to provide heating and cooling needs. If you look today, it's actually not a very heavily utilized technology. We're at about 25% in the Southeast and only about 10% in the West, and even less as you go into the Midwest and the Northeast, as cold climates are more challenging. However, if we think about a future scenario where we have full electrification of buildings, full electrification of EVs, to Joe's point, we don't just have to build out renewable energy to meet today's demand, we have to meet tomorrow's demand. And that can be projected to be as high as 3 times what we're using today. So we need solutions that can help us manage very high renewable penetration. So if we think about this with a very large load, if buildings are the majority of our load, if we can adjust our building load to actually follow production. So today, as we know, we just use whatever we want to use in our buildings, and the grid has to meet that demand by constantly ramping up variable power supplies. In this scenario, we're actually going to moderate or modulate our load, shifting our demand to when that power is available, and actually using the buildings themselves as storage. And so how do we do that? It's through intelligent control in the building and breakthroughs in AI in order to allow us to do data-driven models and predictive control is really advancing what we can do in this space in terms of ensuring that all of the resources in the building is available to the occupants when they need them to ensure their comfort and productivity, while also allowing us to shift our energy use to accommodate those renewables and really decarbonize. So if you think about your water heater as a good example, it's on all the time, keeping that hot water hot, whether you're using it or not, right? If we can be better about predicting when we're going to need it and deciding when to charge that tank so that we're using power when it's available, we can actually use that as storage. We can also use the building itself as thermal storage by pre-cooling or preheating the building. And the more efficient your envelope is, the longer duration, right, that you can actually move or shift when your energy use is to keep everyone comfortable and productive while minimizing your energy use at times when renewables are not available. So we've had 2 demonstrations already that have been really successful in showing how much we can improve efficiency using 42 to 44% less electricity. These are new construction, so highly efficient buildings, a townhome community and a single family community in the Southeast. We are also able to show that we can use significantly less peak demand, which is some of our dirtiest power today. And we really wanted to take this initial work and scale it up and say, okay, we've shown this in field validation now, right? An initial demonstration. We have this commercialization valley of death that we see, and we really want to move these technologies and scale them up. So in order to address that, we launched a funding opportunity announcement called Connected Communities. And it was to take GEBs, grid interactive efficient buildings, and scale them up so that we have multiple different building types, not just new construction, but existing. That's absolutely must be addressed as part of this. Commercial and residential. So those previous communities shown were all residential. So how do we also leverage commercial buildings for this? And we ensured that in all of these, we had a range of variable renewable technologies. So wind, solar, and also EV charging. So being able to manage when we're charging our EVs as part of this and really looking at that as part of this larger optimization. So happily, just last week, 1 year to the day from the initial announcement of the funding opportunity announcement, we selected 10 projects, and they're all across the US, different climate zones, different regions, different utility structures, in order to show how this is possible at a larger scale and more broadly across the country. And the goal here is to bring all those learnings together and really show how this can be propagated throughout the US to all these, across all these regions, in order to really, really decarbonize and provide the grid the support it needs as we move to higher renewable penetrations. And 60% of the selected projects that we have also address our energy justice goals. So a lot of them include affordable housing, multifamily housing, and in disadvantaged communities. So showing that what we're doing isn't just applicable to the shiny new developments, but can be applied broadly across the US and really benefit everyone. If you want to learn more about this, a quick Google, Connected Communities, DOE, 61 million, they'll bring it up. There's a list of the details of each of these. I'm not going to go into that now. I think that would be way too time consuming for the small slot we have here. So with that, I will turn it back over to you.
Thank you very much, Erica, for this very interesting presentation on buildings. So that brings us to the third and final panelist for today. So I'd like to welcome Dan Boermaster, who is the Senior Program Manager for Electric Transportation at the Electric Power Research Institute, an independent nonprofit center for public interest, energy, and environmental research. So Dan has worked in the electric vehicle industry for 12 years now. Including 2 years at the California utility, Pacific Gas and Electric, which was the first company you joined after graduating from Wharton in 2008. So Dan, the floor is yours.
Great. Hi, everyone. And good morning, good afternoon, wherever you are in the world. And thanks for having me today. So I'm going to talk a bit about just kind of the background of where the global EV industry is at, just to help frame the further discussion. And the first kind of obvious situation is being driven largely by stick and now a bit by carrot. So the stick is the global regulation and some economic drivers. And you can see, whether it's cities, states, provinces, countries, there's a variety of proposed or evolving kind of ban on vehicles that have an internal combustion engine. Granted, those are all kind of shaping out in different flavors. They might get delayed and all that, but this is kind of like a snapshot of today. And in parallel with all that, the global automakers, including ones, some of the newer ones, are investing billions in this. And here you can kind of see similar timeline. Now these evolve over time. There's been some big announcements this week from some of the global companies. But the point is, there's a mixture of kind of competition and regulation that is forcing this, along with, I would say, in different parts of the world. We'll get to that in the next slide. Some economics. So here's a look at 2020 sales. Now with the global pandemic, metrics from 2020, 2021, I think are going to be interesting to look back on 10 years from now and see how they are. But here you can see the major car markets, the car companies. We saw that slide previously about scale. The car companies obviously compete globally. You might wonder what happened in Europe January 1st. Well, the EU has some pretty strict regulations that went into effect January 1. So all the car companies built vehicles that plugged into the wall and launched it for sale there, and they spiked quite up. And China's been interesting because they are trying a couple of things. Obviously, they have environmental regulations that they're pushing, which are basically California's but more strict. But economically, they are trying to jump over the existing automotive industry. They're trying to jump over Munich, Stuttgart, Detroit, Tokyo. So they pushed really, really hard and expanded their industry, both the vehicles and components, batteries, and everything in between. So a lot to watch there. There's going to be headlines, good and bad. There's going to be consolidation, as we all know how that works. And then the U.S. is a distant third. So here's some U.S. data. My apologies to the folks on the phone who aren't U.S., but this is just kind of a look at the vehicles divided into kind of four major shapes and sizes. And there's different ways to slice and dice this. But the point is that some of the biggest vehicles, which are numerically a small percent of the market, actually consume some of the most energy and then obviously proportionally pollute the most. And it is everything from carbon and greenhouse gases, which we all talked about, but it's also the more immediate, air quality, all the stuff that comes out of the tailpipe that gets into your lungs that also is impacted by the electrification. So this is the last day, and this is just hot off the press from yesterday. So there are about 2.1 EVs on the road in the U.S. today, and this is kind of how they're spread out across the country on a county by county basis, like a 12-month rolling snapshot. And yet, just as a data comparison or a data point of comparison, Norway's been in the headlines. They're north of 90% for their 12-month rolling average. So Norway aside, because they're pretty unique, there's quite a few Scandinavian and other European countries that are in the teens to 20s. Here you can see, obviously, the more yellow a county is, the higher the penetration of EVs, and the black is either unpopulated counties and or 0%. And what we're seeing over time is a couple of things. Again, there's the regulation, largely led by a group of about 13 or 14 states. Those are the ones highlighted in the blue, the light blue. They have stricter requirements than the feds. But what we're also seeing is, in addition to the regulations, we're seeing more and more pockets around the country where these vehicles are just starting to take off. So the list on the left is the top top 20, kind of, and let me explain that in a second, of the where the hottest or that has the highest percentage of EVs across the country. What we did is most of those are in California. So for the first 5 are in California, as you can see on the list, and then excluding California, so slots 6 through 20 are the remaining 49 states, and kind of get an idea of what's going on. I would say the other thing we're seeing is a couple things. Obviously, the early markets were the higher income tech hubs, college towns, things like that people might expect. What we're seeing now over time is that the demographics of some of these counties with higher adoptions are shifting down to more kind of like mass market, called average counties. And then we're seeing them too in places like the Rockies or the Midwest where they don't have as strong regulation. So, one of we talk about this later, but one of the problems for so long was just that, the EVs kind of came in 2 flavors. Either the great little hatchbacks, but Americans don't really like hatchbacks unless they're lifted a bit. And then, the more expensive vehicles, Tesla, probably like the biggest example, but there's quite a few, competitors in that bracket. Now what we're seeing, and again, more to come in the next 2 years, is that, more and more EVs are coming out there in the shapes and sizes that we Americans kind of know and love. So a lot to, big impact on the utilities, big impact on the regulators, car companies, other stakeholders, and lots looking forward to the discussion coming up. So thanks, everybody. Appreciate it. Oh, I got one more slide. So there's a variety of charging infrastructure that's gone in the ground. There's private money, Wall Street money. There's government money. There's penalty money from the VW settlement, and a similar one in California. Then the fourth leg would be what you see here and across North America from the utilities that are putting in infrastructure. Some of these utilities own the charging stations. Most of them do not. The last 10 feet is done by the private market. So happy to talk more about this during the discussion, but kind of want to give a snapshot of what's going on in the world with EVs and infrastructure. So thanks, everybody.
Thank you very much, Dan, Joe, and Erica for setting the scene here for our discussion. And I want to make sure we have enough time for questions from the audience, and I already see some really good questions in the chat. So what I'll do is I'll ask you one question for all 3 of you, and maybe you can give me just a brief reflection on this. So we've been talking about 2 developments, right? This strong growth in renewable energy, and then predictions for electric transportation that are going through the roof. So that leads me to ask you, what do you see as the greatest barrier to all this? So you can either comment on the greatest barrier to the grid becoming, mostly renewable, or the biggest barrier to EV adoption.
Maybe I'll start. So the last panelist mentioned something I think that really struck home with me, and that was kind of my interpretation. My words, not his. It's like kind of a misinformation or disinformation. I think, whether it's EVs or other forms of, alternative fuels, I think there's a lot of work to be done, not only on the whole market, but there's just a lot of claims out there that may or may not be grounded in fact. So that's the first one. And then I would say the second challenge is just kind of incumbent industries and what they're used to, whether it's utilities or regulators or the energy companies. Everyone's kind of used to their role, so I think that's all changing. And the question is, are those companies changing, at the pace that the market is? And then I would say the The third barrier, and this goes back into the what I mentioned a few minutes ago, this is pretty specific, but there just hasn't been, right now there's in theory about 50 EVs on the road. In a couple of years, there'll be about 150. But most of those EVs have just not been mass market type EVs. And that is changing, and it will change, and that's a good thing. But I recognize full well, having lived overseas, that the pickup truck is a uniquely North American product, but we North Americans love them. And now that we have those coming, and similarly like the small crossovers and the big SUVs and things like that, like it's a conversation over drinks for whether that we should be driving those vehicles. But that's the market speaking. So I think for me, those are the three major barriers.
I'd actually like to take your question and flip it around, and not what's the biggest barrier to more EVs, but how can electric vehicles really support the rollout of more renewable energy onto the grid? It's critical we don't think of EVs as just power takers, but also as part of a massive dispersed generation system that can put power back in where it's needed. It's interesting, Ford just announced that the F-150, the electric truck that they're going to put out, is going to be set up to provide emergency backup power for household owners. That's the first step in a much bigger step that really could be catalytic, which is, how can we set standards and policy incentives to migrate all manufacturers of electric products like that, so that they can create this dispersed power system or set up massively dispersed power plants, so that they become part of the solution. And we're not just building standalone backup power generators that only get used 1 to 5% of the time when they're needed, but they actually can send power back into the grid too. So I really think more EVs can be a bigger part of the solution of how do we get more renewable energy onto the grid.
I'll add to that. I think if you look at what is the biggest barrier to increase renewable, it's that need for energy storage to manage that level of demand, and the risk adversity that we have inherently in the certainly understand, right? So we're talking about a more connected.
Erica, the line is breaking for me. Is that an issue for me or for everyone in the audience?
Yep, I couldn't hear it either.
Oh, I'm sorry.
That
I'll
was better.
put my response in chat, maybe.
This works, by the way. Maybe it's
okay.
just where you're.
I don't know.
Yeah.
All right. I was just saying that I would add to that if we look at the simultaneous increase in renewables and EVs at the same time, that increased load requires significant storage. And I think that's one of the large barriers. And using all of these individual assets increases our cybersecurity risk, and in a utility market that's inherently risk adverse for very obvious reasons, right? So I think that a large challenge is showing that we can do all of this coordination reliably and securely at scale is a large barrier that I would see as part of this.
Thank you very much. So I think it's time for some questions from the audience. So I see a number of them in the chat. I'll just start with a question for Joe by Robert Gennardi. Robert says, Joe, with natural gas and oil prices escalating, major utilities are actually quickly shifting back to coal. That's been in the news quite a bit, maybe also with the crunch in Europe right now. And a lot of people are saying that renewables are not sufficiently at scale to carry the load. And maybe that'll take another decade. So is that, how do you respond to that view of the world?
Well, it underscores part of the problem with relying on volatile commodities to power our system as well. Gas is a historically very volatile commodity, and prices go up radically. We saw during COVID, they can also go down radically. Part of the benefit of renewables is we don't have to pay for the sun, we don't have to pay for the wind. I think much of the solution is to look at, in our US market, we're really set up as a series of regional markets. States or localities don't operate in a vacuum, but they do have the opportunity within the regional markets of the ISOs that they work with to purchase power for peaking needs. And that's an important element, is being able to purchase power in a wholesale market to cover where peaking is going to occur. But it's also looking at how we can create incentives to flatten out demand. After 80 years of increasing power demand in the US, we started seeing our overall demand flatten about 10 years ago. And we can continue to get smarter with things like time of use tariffs that shift demand away from when peak periods occur to off-peak periods, so that we can further flatten that demand out. So no, I don't think we need to go back to more coal-fired power. We need to continue with this transformation, and we need to be smarter about creating incentives for when our load is going to occur.
All right, thanks. And then I see a number of questions in the chat about electric vehicles. So one question is, why are US car manufacturers not making electric cars with vehicle-to-grid charging capability? Would that help utilities smooth out variable energy without capital cost? And then maybe to add to that, because it's also about electric cars, we haven't talked much about battery recycling. The New York Times ran this article about a year ago, sort of saying that I think only 5% of batteries are recycled. Aren't we waiting for an enormous problem once like 100% of the fleet is electrified, and then we have these, massive piles of batteries? I guess, Dan, that you would be the first one to comment on that.
Yeah, great. So thank you very much. So the vehicle to grid or smart charging and the battery supply chains. So the car companies actually are making test vehicles that do vehicle to grid. Actually kind of working quite closely with us. It's a learning process. They're starting off with kind of one way kind of smart charging capabilities. It's the whole idea of, say us as consumers and kind of pre-COVID, like charge my car, by 5 a.m. during the week and 7 a.m. on the weekends, and I'll plug it in when I get home from work, regardless of what time that is. And I don't care what you do, as I'm cooking and sleeping and all that kind of stuff, as long as it's charged again by 5 or 7 a.m. So that exists today. There's utilities and car companies doing that. And that leads to the two-way power. Two-way power of any kind is challenging not for technical reasons. You can make electricity flow any direction you want, but it's more for kind of safety and cost. So the Ford product was mentioned earlier. That's going to basically be just like a generator you might have in the Northeast, where you have a critical panel that the customer installs. We call it the $1 million minivan, but we're demonstrating some vehicle to load, vehicle to building type work. It's coming. I think people might have seen, people in the industry might have seen after Fukushima, the Japanese did a lot of power export. It's a question, in my head, there's kind of three levels. There's, call it vehicle to circuit or vehicle to garage or vehicle to building or whatever, vehicle to load. That's like step one, and with reverse power. Step two would be, vehicle to grid on the actual distribution system. And then the third level, which was wildly popular 10 years ago, vehicle to grid is like on the wholesale side. And to get to that point, that requires intense scale, as well as there's some questions about, scale of EVs versus scale of batteries and the kind of the closing, the market clearing price. So, it's a stair step, but I think, I can see us getting there. And, like it or not, whether it's been the February outage in Texas or some of the firestorms in California or the bad weather in the Northeast or Southeast, it's top of mind for regulators, customers, I don't know, some customers anyway, and utilities and other stakeholders. So there's a lot of work being done. That's not quite done yet. And speaking of batteries, I think, it's a very real challenge, and I'm glad so much attention is being put on batteries, because, we, at least in the States and the European sensibility is quite different. We in the States don't talk about enough where stuff comes from and the consequence of it, whether it's a battery or steel or what have you. So there's real world consequences to mining of any kind, whether it's batteries or other things. And then, as far as end of life, it's mentioned, I think Joe was the one who mentioned, there's a lot of work going on right now. Some pretty big name leaders and startups looking at that end of life. And, to me, it'll all reach kind of a market clearing price where it's first of all, these batteries have been proven to be very durable. So they last a lot longer than everyone thought. And then as they get towards a quote unquote end of life in the car, it's like there's kind of a couple options. Like, you repair the cell or two in that vehicle and just keep going. Do you swap out packs and then repair the pack and put it in a different vehicle? Do you take the pack out, put a new one in the vehicle, and then just take apart the old pack? And again, like we spend all this time gnashing your teeth, like talking about the supply of these components, and then on the flip side, we talk about end of life as if the components have no value. So I think we got to kind of balance those two extremes a bit. But there are numerous challenges. I agree with Joe. It's not just it's the sourcing, and then there's the question like where are all these raw materials processed and how and all that. But as we're seeing right now globally, we got some major supply chain issues, not just with battery components, but with everything.
Thanks. Erica, I have a question for you. So I'm quite fascinated by smart buildings, but then, I live in Center City, Philadelphia. I look around at these old kind of crappy houses and basements that don't look terribly smart to me. So when you think about what's really needed to make this, to make smart buildings a widespread phenomenon in the US, what kind of policy or action do you think is needed? And specifically also as an economist, even though it's hard to say the word real-time pricing after the Texas disaster, but to what extent is it important that people actually face, a time-varying price of electricity?
So I think part of it is we're seeing multiple different programs that maybe aren't even using real-time signals for the grid pricing. There was a really good example, Green Mountain Power in Vermont did basically a program where you could choose to participate, and it was more like a Netflix deal, right? You could pay one price, and as much as you use or don't use, it's just that they have access to that asset, right? So they have an aggregator that provides an incentive, and the aggregator is responsible for bringing these loads together and providing that as a service. And the homeowners get the value just for signing up with this aggregator, a smaller incentive. And I think that's a nice example of limiting the risk, right? Because now it's the aggregator that's dealing with how do I aggregate, how do I confirm my load and bid into this wholesale market. And FERC Order 2222 really opens that door up much wider by requiring that to be, available to all utilities, all areas to be able to have this aggregation as part of this. And it limits the risk to the customers. They can always choose to stop participating as part of this service and therefore no longer receive the incentive. In terms of how do we take these old buildings and make them smart, I think that starts really at the equipment level. So yes, it's much more efficient to upgrade your envelope as you're also upgrading these, but that's an expensive proposition in most places. So how can we utilize the equipment we already have, the water heaters we already have, and the heating and cooling systems we already have in the buildings? Smart thermostats are a great low-cost example of a way that we can then start communicating and manage those assets. And we're seeing similar developments for water heaters as well, where you would have basically a small retrofit device that allows remote control over that water heater. And that's a way that we can start making these buildings smart and intelligent in a low-cost way that allows us to ramp up and start participating in these markets. And also we can do it without real-time pricing.
Thank you very much. I think we probably have time for one more question before I think we're gonna hand it over and go to the networking part. Joe, question for you. What are the technology advancements or new technologies that you think would have the greatest impact on how fast we can go towards renewables?
I wish we had an hour to talk about that because there's so many areas we can go. We've talked quite a bit about battery capabilities, but we're still in early stages of getting more out of our batteries with less componentry and seeing the technology advancements that are going to come. I'm very excited about offshore wind, and we're going to see and are seeing big investments in offshore wind. Virginia, New Jersey, the West Coast. Europe is way ahead of the US in offshore wind usage. We're going to see that. Cleaner hydrogen, particularly for industrial use, fleet transportation. and potentially for power generation is going to be very catalytic, where batteries are not the solution necessarily. Check out what the Department of Energy is doing with their loan programs office as far as helping to fund really catalytic, groundbreaking companies around cleaner hydrogen production. Monolith Materials in Nebraska, company called ACES, if you Google that, which is going to be storing hydrogen in salt caves in Utah, is another really innovative, interesting business model. But I think that clean hydrogen has a long way to go, even with carbon capture. And Iceland, we've got now the largest direct air capture facility in the world. And the prices are going to have to come way down to make a market, but it's coming, and the technologies are going to continue to make it more cost effective.
That's all very, very exciting. Yes, and as a European, I can say the offshore wind is, it's a big deal in the Netherlands, my home country. So before I hand it back to Cheryl, let me just take 1 minute to say, as a faculty member here at Wharton, it's great to be with many alumni here in this conference. It's been phenomenal to see in general the enthusiasm by our alums, by our students, other faculty members who are moving their research into climate and energy related areas. Wharton is really trying to step up. I'm co-leading, joined with Sarah Light, the Business, Climate, and Environment Lab at Wharton. If you have ideas about how we as academics can be useful and in helping answer questions about the transition to a low carbon economy, ideas about ways to work together with Wharton, we're extremely excited to hear from you. So don't be shy. Just Google my name. Academics are easy to find on the internet. So thank you very much. I want to thank Erica, Dan, and Joe for their very insightful comments, and I'm going to hand it back to Cheryl.
Thank you, Arthur, and your panelists. Really fantastic insights into the transportation and built environment sectors on the current state of the transition. So thank you so much. I hope that you'll hang on, because we're moving into a networking session just for the next 15 minutes to the top of the hour, where participants can ask you direct questions, or network with each other. I'm just going to share my screen here, which has some instructions for you. I think it's pretty straightforward, but just to say that this networking session will be in the chat, and so there will be no live discussion. As you can imagine, with 100 participants, that might get kind of loud. So please do leverage the opportunity to connect with the panelists and other participants that you've noticed that are in the session. Thank you to everyone for this mitigation day of the Wharton Climate Change Conference, and to all of our speakers, panelists, and our keynote today as well. Let the networking begin.